Madame la Présidente du Conseil exécutif de l'Union africaine, Madame la Présidente de la Commission de l'Union africaine, Nkosazana Dlamini Zuma, ma sœur d'Addis, Mesdames et Messieurs les ministres, vice-présidents et commissaires de l'Union, Excellences, Mesdames et Messieurs, le moment est venu pour nous de regarder en arrière et de revenir sur 2014, année cruciale pendant laquelle l'attention du continent s'est centrée sur d'importants éléments constitutifs du programme de transformation, notamment le rôle déterminant de l'agriculture et que l'agriculture peut et doit jouer dans l'amélioration de nos perspectives d'industrialisation. Faisant nôtre le thème de cette année, autonomisation des femmes et développement en vue de la réalisation de l'agenda 2063 en Afrique, nous devons rendre hommage aux nombreuses dirigeantes qui luttent pour que les femmes du continent occupent une place plus visible et un rôle plus décisif. La présidente de la Commission de l'Union africaine incarne les progrès que l'Afrique est en train de réaliser en termes d'autonomisation des femmes, mais nous devons encore faire beaucoup plus. Alors que nous nous apprêtons à adopter le cadre général de l'agenda 2063, nous ne serons pris au sérieux que si notre priorité est la transformation de la vie de nos populations. Le nouveau récit sur l'Afrique, mêlant croissance, investissement et multiplication d'opportunités, a été sérieusement ébranlé par des événements récents. Après la réaffirmation de ce nouveau discours, preuve de réussite à l'appui, dans de nombreux forums, dont le sommet de l'Union européenne-Afrique et le sommet organisé par le président Obama à l'intention des dirigeants africains, des pronostics inquiétants sur les incidences économiques qu'aurait la maladie à virus Ebola sur les résultats du continent ont enclenché un cycle négatif d'information qui s'est rapidement propagé. De plus, l'Afrique a été touchée par la baisse de la demande internationale en conséquence de la récession mondiale et par la chute des prix de matières premières, la forte volatilité des marchés du pétrole et du gaz et des conflits armés. Les avancées des 15 dernières années sont si fragiles que beaucoup ont prévenu qu'elles pouvaient en fait être réduites à néant. Se pourrait-il que la tendance au réveil de l'Afrique soit sur le point de se retourner? Ladies and gentlemen, the world is slowing down. Africa, fortunately, is not. Economic stagnation in Europe and Japan has seen the introduction of stimulus packages that dwarf Africa's economic size. Yet the public deficits there continue to grow, and the malaise of deflation has become their number one concern. Recent positive growth in the US has contributed to the phasing out of its quantitative easing measures, with enormous consequences for the currency markets, eroding most of the gains from largest exporting regions of Asia and Latin America. Meanwhile, Russia's economy is contracting fast, and China is experiencing its slowest expansion in nearly a quarter of a century. The International Monetary Fund has just revised its global growth forecast down to 3.5%, despite the economic incentives that cheap oil prices should, in theory, provide to industrialized economies. The extent of the damage caused by the 2008-2009 financial crisis is still being assessed. Many observers believe we are not out of the doldrums, justifying strong calls by the US and the European Central Bank for new policies. Africa seems to be doing better than the rest, though. While its forecasted growth has been revised downwards too, Africa's growth forecast is still higher than any other continent. According to the latest estimates by the IMF, Africa should see growth in 2015 of just below 5%. However, if previous crises are anything to go by, Africa may well perform better than predicted. I know some might accuse me of being overly optimistic, but in fact, the reasoning behind my high expectations is widely shared by specialists. According to a recent Ernst & Young report, Africa is the second most attractive investment destination after Southeast Asia. The report also revealed that intra-Africa foreign direct investment has soared and is currently growing at 32% a year. According to the World Bank, by 2030, the continent's savings will total $23 trillion, up from 12 trillion at present. Rand Merchant Bank estimates that disposable income is growing by over 5%, and McKinsey has Africans as the second fastest growing consumer market in their predictions. Deloitte & Touche argues that what is true for the consumer market stands also for investments by 2017, the second largest consumer investment market. Standard Chartered believes actual growth on the continent could be closer to 7% if accurate numbers could be collected. Indeed, every country that has carried out a rebasing of national accounts has found that its economy is considerably higher than previously thought. Meanwhile, financial data provider Dealogic estimates that more than 656 mergers and acquisition deals may have taken place in 2014, up from just 67 in 1995. Financial Times has reported that the London Stock Exchange is, and I quote, launching an aggressive attempt to increase the number of listings of African companies, and of quote, given the enormous demand for these stocks. Ladies and gentlemen, there are still skeptics who remain unconvinced. In order to persuade them, we need to do better. We can start by acknowledging that 2015 will be a testing year. First, falling commodity prices are a reminder that Africa cannot continue to remain at the lower end of the value chain. Geopolitics is at play in the decline of global crude oil prices. The falling prices of 44% between June and December 2014, a monthly average decline of about 7.4%, is happening on the back of the shale gas boom in the US, coupled with huge accumulated stockpiles, artificial price increases in the recent past, and lower demand from emerging economies. But let's be clear. Africa accounts for just 7% of the world oil output, 3.6% of coal production, and only 1% of gas output. Nevertheless, energy is Africa's largest export, and as a result, the continent will feel the effect of the fall in oil prices. However, as most African countries are oil importers, the current price trends are welcome. In addition, Africa is expected to reduce its energy exports from 51% of total production to just currently to just 36% by 2035 in order to meet what has become now more important, growing domestic demand. Natural gas export projects have been derailed from Australia to Africa. Tanzania, Mozambique, and Nigeria all hope to develop giant gas fields. While this would give their economies a short-term boost, it could tie them into a commodity cycle in a market where the dominant position will be assumed by the United States. Meanwhile, China is filling strategic and commercial reserves at relatively little cost. Analysts suggest that 308 million tons were imported in 2014, not merely demand-driven, as China has also increased its exports of refined energy products. This is additional competition for African countries, which need to enter the refined products market in order to continue the diversification process. Nigeria, Ethiopia, and DRC are still very modest per capita energy consumers, despite their large populations. The diversification process offers an opportunity for African oil producers to finally shift from exporting crude to transformation. The future of our energy production is to look at the demands of the African markets. However, for the time being, oil prices indeed will impact Africa's growth for 2015, but the decline will be 0.07% as a result. Metal prices have fallen far less than oil prices in the past 6 months. Nevertheless, for countries that depend on one single metal, such as Zambia, this will hit them hard. Fortunately, most of the continent's soft commodities have not been similarly affected. In any event, the continent's economic growth is now more diversified. Governments have worked hard to make life easier for investors. Rwanda, 20 years on, is now more open to investors than Italy. Foreign investors are becoming more interested in the non-resource sectors of African economies. Indeed, a third of intra-Africa foreign investment goes to the financial sector. Most of Nigeria's growth has come from non-oil, such as financial services. Between 98 and 99, when oil prices fell, Nigerian Naira lost 80% of its value. Today, services represent 60% of Nigeria's GDP. Angola, Africa's second largest oil producer in 2013, experienced growth of 5.1% last year, and most of it came from manufacturing and construction. Second, most of Africa's growth actually comes from internal consumption. The continent is less at the mercy of commodity markets, as telecommunications, transportation, and finance are all expected to spur economic growth. Better fiscal policy is playing an important role. Financial markets have heeded the call from African countries to fund their huge needs for investment into infrastructure and services through sovereign debt. Kenya has, in the midst of its fight against terrorism, received $2 billion, while Ethiopia, Nigeria, Senegal, Rwanda, Ghana, Zambia, and Cote d'Ivoire all had demand that outstripped their bonds offer. Others have been able to access funds directly, such as Djibouti. However, it is important to note that these times are changing. The lower rates obtained by some countries are likely to jump into light of increased risk perception. This will make debt control calls more strident and buyers more cautious. Third, we now have a clearer understanding of the impact of the Ebola outbreak on the continent. From the start, ECA was confident that the alarmist projections were wrong and as we could not visualize more than a marginal impact on the region's performance, given that the three most affected countries account for less than 1% of Africa's combined GDP. Nevertheless, the suffering experienced by Guinea, Liberia, and Sierra Leone is considerable. Their relationship with international financial institutions is at a critical juncture, as the imperative for debt cancellation is being discussed after the vocal case for it made by ECA. Debt relief should not lead to a lack of confidence about the viability and credit worthiness of these countries. The countries face unique and complex development challenges that have limited their ability to contain the Ebola outbreak while continuing to promote economic growth, improve public service delivery, meet regular debt repayments, and plan for economic recovery. The outbreak has exacerbated weak initial conditions, structural vulnerabilities, and limited potential to sustain growth under widening fiscal deficits. External debt cancellation would therefore give the three countries the breathing space they need to recover. Excellencies, in 2014, only Africa managed to grow as an investment destination. Nevertheless, we should not allow ourselves to be carried away. The continent attracted just 3.7% of the 1.5 trillion of total global investment. About 20% went to South America, 30% to Asia. Interest in Africa is still not translating into hard investment. China, for instance, for all the talk, invests less than 5% of its total foreign investment in the world in Africa. Incidentally, Africa's value proposition is equally attractive to China as it is to India. Total investment stocks held by China and India are very similar, although Chinese investment tend to attract far more attention. India is an important source of investments too. India, and indeed Malaysia, which holds more investment stock in Africa than any other developing country, have been quietly buying their way into various sectors of our economy. Our strategic direction will influence the nature of such partnerships, both old and new. And finally, fourth, we cannot discount the impact of ongoing conflicts, which divert major productive resources. Local conflicts are becoming affiliates or franchises of global terror networks. Economic transformation ought to make resources available to manage African diversity. Pastoralists, for instance, missing out on economic transitions in the Sahel sub-region have found a heaven in terrorism. Extremism, particularly religious extremism, as practiced by Boko Haram in northern Nigeria, Seleka, Anti-Balaka, Al-Shabaab, some of the Libyan militias, ACMI and Mujao, are manifestations in part of an inability to leverage the productive forces of the continent. The situation in Somalia is a stark reminder that conflicts have regional and continental implications. Their impact on the continent's economic performance stretches from missed opportunities to contagious risk perceptions that are much more serious than those surrounding the Ebola outbreak. Ladies and gentlemen, in order to secure growth, cash, and jobs, markets need to expand. We have 2 years to go before 2017. Establishment of the Continental Free Trade Agreement, which will represent a fundamental change for current and future generations. Africa's trade performance has been relatively impressive, with strong increases especially since 2000. However, we have failed to diversify exports from primary products and natural resources, limiting the potential for industrialization. This can be explained by highly ineffective trade policy design, implementation, and coherence. Moreover, the asymmetric trade agreements that we continue to sign have led to insufficient incentives for industrializing through trade. We must be bold and courageous when we negotiate. If we create a common market, it will have the size of China's population. There is not long ago until the deadline of 2017 arrives. If we cannot achieve that, then who will believe in Agenda 2063? Africa's 3,000 richest individuals now have an accumulated wealth approaching 400 billion. Together with the 600 billion that our central banks have accumulated in reserves, that equals 1 trillion wealth. If we just look into these figures in terms of Africa's own capacities and resources, we can start charting the way forward. The new African narrative is alive and well for now, but it is still a little shaky, and we absolutely cannot allow any coughs or sniffles to turn it into an epidemic. Thank you.